we had looked at the introduction part of the conceptual framework, where we discussed the purpose, why we really have this conceptual framework as our Bible as accountants. Then we looked at the qualitative characteristics. These ones are a must for you to know. And we discussed the key elements of financial statements. That is the assets, liabilities, equity, income, and expenses. At one point, where when you're stuck of treatment or with treatment of a given transaction, once you remember the definitions provided by the conceptual framework, you can be able to classify the transaction either as an asset or a liability, an equity, income, or expense. So you should really pay attention to question 4, that always tests for your understanding of different key elements or transactions that investors always have an interest in, even though there might not be any guidance from an existing standard. So after looking at this, we have the conceptual framework also guides us on recognition. Yes, it has given you the definition of the key elements that should go into the financial statements. Now the question is, what should you recognize and what should you not recognize in the financial statements? As I told you, you first assess if the transaction really meets any of the definitions given by the conceptual framework. Then after that, you have to ensure that yes, even though the transaction meets the definition of the elements, but does it also pass the requirements of the qualitative characteristics? Is this information going to provide relevant information once recognized in the financial statements? And is this recognition really providing faithful information and therefore gives the readers of these financial statements what we call clear entity performance as well as position? So those are the 3 major points that we look at under recognition. That even when you're given a scenario in an exam and an accountant is recognizing a transaction which either does not meet the definition of an asset or liability, and its recognition does not really provide relevant information, and it is disorganizing or it is not giving the true picture of the performance and position of the entity, then you can use that background to challenge that transaction, even without referring to any accounting standard. I told you that the SBR is more of a practical paper where you give your opinion as an expert in a given field. I always give this example of future losses. Assuming that the accountant is making a provision for future losses and you do not know what IS 37 guides, but you remember the definition of a liability, okay? You remember the definition of a liability as per the conceptual framework. And you also remember the key characteristics of what should go into the financial statements. Then you can challenge. You can base on this knowledge for you to challenge the recognition of that future loss. You see that a liability is defined as a present obligation to transfer an economic resource as a result of a past event. Natasha, are you following?
Yes, I'm following.
Then you provide, then you say, okay, that is one. That future loss is not as a result of a past event. You challenge from that angle. Then you go back to the characteristics, okay? That transactions should be based on economic substance rather than legal form, and this should be free from errors, neutral, and complete, so that we provide a faithful representation of the actual position and performance of the entity. So what does it mean? If we make a provision that includes transactions that are in the future, then we are presenting information that is having errors. And so we are not giving the actual performance and position of the entity. As such, this accountant should reverse the transaction. That is someone who does not know what IS 37 says about future losses. But this person has strong knowledge of the conceptual framework and its guidance. I don't know if I'm communicating. Rachel, am I communicating? Rachel, am I communicating? I know Rachel is on call. Okay, I just want to get confirmation from Anisha. Is the point at home?
Yes, Ivan.
All right. So that's how you can use the conceptual framework information to scoop marks in the exam. Please make sure that your mics are mute in case you are not submitting anything. Transactions should be recognized in financial statements if we've said that one meets, okay, if they meet the definition of an element, and the second requirement, its recognition provides relevant information. Of course, you should be knowing what relevant information is. Free from errors, neutral, complete. Those are the statements that you should use in your explanations. Relevant information, and lastly, its recognition faithfully represents the entity's financial performance and position. So this is the guidance provided by the conceptual framework regarding recognition. The number 4 guidance that the conceptual framework provides is derecognition. Derecognition. That is, recognition is including recognition is including a transaction or an item in the financial statements, whereas derecognition is removing an item from the financial statements. So the standard says, okay, even before giving the guidance of the conceptual framework, who can share with us what do you think should be considered in the process of removing an item from the financial statements? Assuming that in last financial year, you had a vehicle recognized in the financial statements, and then this year you want to remove it, what should be followed? Anyone who can try?
Can I try?
Yes, please.
So I think, like the example of the vehicle you have given, let me also use a vehicle. If it's let's say it's damaged or its time of use is done, then it can be derecognized. That's what I feel.
Okay. When its time of use is done, okay, that is it. It no longer gives an economic benefit to the entity, right? Okay. Anyone else to try?
If it's no longer controlled by the entity.
Perfect. Once you have no control over that vehicle, maybe you've sold it off, okay, or you have transferred to another party through different arrangements other than sale, that's when you should remove such items from the financial statements. Okay, so we can say items can be derecognized, from financial statements if one, an entity has lost control of the asset. And of course, let me hope we all know the definition of control. At this point, those who are sitting in March, I'm sure you've started on group accounts, but also the conceptual framework detailed explanations and contents also give when we have control of an asset. That is, if you can direct the use of the asset and enjoy all the economic benefits. These are things that should be on your fingertips. Okay? So if you cannot direct the use of this asset anymore, or you cannot enjoy the economic benefits that arise from the use of that asset, then you no longer have control. As such, you should remove it. This should take you back to leasing, especially finance leasing. Okay? Sell and lease back, where we always look at loss of control. You realize that most of these standards they pick their foundation from the conceptual framework. And then the second condition under which we can remove an item from the financial statements is when you have no present obligation for the liability. That is, if you had an obligation to pay money and you've paid your money, then you no longer have a liability. As such, there is no further present obligation present obligation for the liability. These are the two conditions under which we can remove items from the financial statements. The second key item that I want to discuss, these are high level reviews by the way. That's why I'm only going through the basic or the key items under the conceptual framework so that we can be able to apply the same in the question we are going to discuss thereafter. So when it comes to measurement, the conceptual framework says whichever item that you recognize in the financial statements, you should be able to attach a value. As such, it gives us two bases that we can use to attach value to the items that we've recognized in our financial statements. The first one is the historical cost basis, and then the current value basis. Under the historical cost basis, we look at the initial amount that was incurred when securing control over this asset. Then under the current value method, The standard says we can use the value in use method, we can use the fair value method, or we can use the current cost method. Okay, so we can say there are basically two measurement bases provided by the conceptual framework. Provided by the conceptual framework. One, it is the historical cost basis. Historical cost. This is, of course, as we said, the initial amount that you spend. And then we have the current value basis. And this current value basis is split into, of course, we know the IFRS 13, the fair value measurement standard. So we are saying we have the fair value, we have the value in use, then we also have the current cost. So you shouldn't confuse these three current value methods provided by the conceptual framework under its current value basis. Fair value, of course, this is the money that you're going to receive in a market that is organized, normal, with no forced sale, where all the participants are fully aware of the conditions under sale. Then value in use, this involves estimating the potential future cash inflows or net cash flows from an asset, and then we discount them to present value. Those who are sitting in March, I'm pretty sure that this information is not new, and for those who sat FR, value in use is something that is very common and we always apply it in other standards. Then for the current cost, if I have a machine I bought 5 years back, I can go to the market and check what is the current cost if I'm to buy the same machine with the same specifications on the market. Is that clear, dear students? Can I move on? Is the measurement basis clear?
Yes.
Okay. And it is important, by the way, that before you select the measurement basis for your asset, this is common with the PPE, IS 16. For it, it makes use of these two measurement bases. You can use the cost model, you can use the revaluation model. The revaluation model integrates fair value within its measurement, whereas the cost model uses the historical cost basis. So what is important? We should always look at the characteristics of the assets. If it is your vehicles, if it is land and buildings, okay, would you prefer using the historical cost for the vehicles and then the revaluation method for land and buildings? The conceptual framework says make sure that you evaluate the characteristics of the assets or of the liability before selecting which measurement basis should be used. Okay, then I would say the next key item that the conceptual framework guides us is the presentation and disclosures. Presentation and disclosures.
I have a question, Ivan.
Please do ask.
About the aspects you talked about that I have to consider before knowing the method. Please, I need an example.
You need?
An example, like let's say it's a vehicle. Which aspects do I really have to put in place in my head to know this is for the evaluation model?
Of course, this can include maybe the purpose, the use of the asset. Okay? If you are buying this, let me say, building, basically for sale, you wouldn't really prefer using the cost model. Why? Because you are interested in knowing the current value of this asset before you make the sale. Does that make sense to you?
Yes.
Then you would go for the fair value method, right? Which can
Yeah.
give you probably a better position or a better value.
Okay.
Yes. And other key dynamics, the availability of open market where you can get fair value. Assuming that that asset is not fully traded on market, you cannot easily find buyers, so you can't establish the fair value. So you better go for with the historical cost or the cost model. Does that make sense as well?
Yes, yes, it does. Thank you.
Okay. Okay, so under presentation and disclosures, I presume there is no further question with what we've discussed. So we can move forward to presentation and disclosures. You realize that we have basically three key financial statements that we always look at as accountants. That is the statement of financial position, statement of profit or loss, and the statement of changes in equity. However, there's also what we call notes to financial statements. When it comes to notes to financial statements, these ones do explain what appears on the face of the financial statements. So, when it comes to the statement of profit or loss, you realize that this as well has another second line item called other comprehensive income. So you'll find some entities calling it the statement of profit or loss and other comprehensive income, or basically you can call them the statement of comprehensive income. This, of course, gives us the financial performance of the entity, and it contains the incomes and expenses. I know most of us are very conversant. Out of the key elements, assets, liabilities are for financial position plus equity, while income and expenses are for statement of profit or loss and other comprehensive income. So the question is, what are those items that should come under other comprehensive income, and why should they not go in the normal profit or loss? One, such incomes like revaluation surplus should go to other comprehensive income, and the reason is because our assets are being remeasured to the current value. Of course, once I say current value, you know that we are using fair value, value in use, or current cost. Because this process involves always remeasuring our asset to the current value, okay, and putting them under other comprehensive income would give us a better representation of the performance of the entity during the year for all items under the profit or loss. Now, what complicates issues is when it comes to reclassification. There are those items that we are allowed to send back to profit or loss at a given point in time, probably at the point of derecognition or at the year end. And there are those that we are not allowed to take back to statement of profit or loss at year end, but rather take them to the valuation to reserves under statement of changes in equity. Those who are sitting in March, I'm sure you've discussed and you are aware that revaluation surplus under IAS 16 is an item that we cannot take back to profit or loss, but rather take it to statement of changes in equity under revaluation reserve. And what is very important for us to note is we only do reclassification to profit or loss if doing so would provide relevant information. In whatever decision we take, we always refer to the qualitative characteristics of financial statements. And we shall always refer to relevancy because this comes up with a very key component of materiality. Otherwise, if you are reclassifying to profit or loss, but that is not giving or it is distorting the interpretability of the financial statements by the users, then you are doing a disservice to the key primary users. Okay, so here we look at a statement of profit or loss and other comprehensive income. Of course, now this brings in the issue of reclassification. And by that, when it comes to financial statement presentation, even in practice, when we are doing our works as auditors, we want accountants to show us specifically under the statement of other comprehensive income, what are those items that are reclassified and what are those items that are not reclassified. The more you interact with other standards, IAS 16, you look at IFRS 9, we have some items that can be reclassified. You realize that you'll be able to identify which items that go under other comprehensive income and should be reclassified and those that should not be reclassified. In fact, when I'm reviewing financial statements, I always look at, when it comes to other comprehensive income, I always check, has the accountant clearly specified items to be reclassified to profit or loss? That is one. Then items not to be reclassified. And those that are under not to be reclassified, I expect them to appear in the statement of changes in equity at the end of the reporting period. I told you this can as well be called the statement of comprehensive income. Warning, this is very key. We are going to look at a technical article. Reclassification is very, very important, and it's going to be a discussion before we close this call. The second one is the statement of financial position. Then we have the statement of changes in equity. Then we have the notes to financial statements. I had forgotten statement of cash flows. Statement of cash flows. These are items that you should be well versed with, given the fact that you're doing what? Given the fact that you are doing SBR. Okay, so not to bore you guys, we've discussed the key items that we should look out for in the conceptual framework. Before you go for your exam, make sure that at least you've gone through all of this in detail and how you can use them to answer questions where maybe a given standard is not clear or you cannot recall the key concepts. You can use the guidance of the conceptual framework to answer questions. So let us walk through the conceptual framework technical article, because that is one of the resources, technical articles, very important, that you can use to crack this BR. After going through the normal texts, you should read the technical articles so that you can consolidate the information that you have. So I'm going to take you to,
I have a question, Ivan. A simple question.
please ask.
Does that mean if asked about disclosure or presentation in a paper, I should be looking at the items that you have listed under presentation and disclosure?
That is a generic question, so I can't really tell what you mean. What exactly do you mean?
I mean, if a question is about disclosure, like what should the directors of a certain company disclose according to, of course, the case they have given me? Does that mean that if I'm talking about disclosure, I will really have to talk about reclassification and all these statements, things that are formed in there, but of course, according to what they have asked in the question?
Can someone answer? Can someone answer, Natasha? Natasha,
Yes, I've
please note that each standard each standard provides each standard provides items that should be disclosed. Okay,
yeah,
so we do provide disclosures as per the guidance of the standard. What I've discussed, I've only given you the presentation, that is the key financial statements, right?
yeah,
Then for disclosures, you find them in the guidance,
understand.
yes, in the standard itself.
Oh, thank you.
Hope that is clear.
Yes, it is very clear.
All right. So